All right, there's breaking news at the bottom of your screens right now, and in a measure to deepen the corporate bond market in India, and in a step that gets it closer for the RBI to begin accepting corporate bonds, a big change has really happened. The development of fixed income and currency markets is what the RBI has indeed undertaken. It has accepted many of the recommendations of the HR Khan committee. Remember, he was the RBI Deputy Governor, just retired a month back, to develop the corporate bond market. And if I may take the viewers through the key things that have been announced. The first, of course, is this has been done to enhance the aggregate limit of partial credit enhancement. Remember, banks can only do up to 20%. This has gone up to 50%. They have permitted brokers in the corporate bond market as market makers. They have authorized the platform for repo and corporate bonds. Supply for large borrowers should happen more through the market mechanism route and less through banks. And that was the real idea of developing a corporate bond market. And of course, like I said, this is one step closer to getting the RBI to begin accepting corporate bonds. That is still not going to happen because it requires amendments to the RBI Act. But the release very categorically says that that work has begun. Let's take it across to Maithili Busnurmat, our consulting editor, who's joining us right here on ET Now on this big breaking news there. Maithili, thank you very much for being with us. We are a step closer, yes, before the RBI begins accepting corporate bonds as collaterals, just like they do with government securities. But we've still not, we've still not had the capacity to bite the bullet there. Am I right?
Well, yes, but I think the RBI's approach in this of being very cautious is the right approach to take, because remember, in our case, the problem is that if corporates default, it becomes very difficult to actually get back your money. So it's very important that the integrity of the central bank's balance sheet is always retained. And even if they are AAA rated corporate bonds, one can never be sure. So in order to retain the integrity and be very sure that the sanctity of the central bank's balance sheet is retained, the RBI is doing the right thing by going a little cautiously on it. Of course, the fact is that you do have to amend the RBI Act. So that is a procedural thing. It's a legislative change. But I think the way the RBI is progressing on this entire issue of corporate bonds is slow and careful, because it's better to be slow and careful rather than be rushed into the act and then regret it later. I think slow and steady is the way to go, and that's what the RBI's policy has been on many other issues, including that of corporate bonds. So I would not really fault them on that. I think they've taken a number of measures, especially as far as the partial credit enhancement is concerned. That is a significant jump from 20% to 50%. So that is a huge change as far as enhancing corporate bonds are concerned. So it is possible for less than AAA rated corporate companies to come out with corporate bond issuance. They've also talked about market making. So I think all these moves together will give a fillip to the corporate bond market, which is very necessary in our country to reduce the dependence on the banking system, particularly since infrastructure finance is such a huge issue in this country, and banks have limitations when it comes to infrastructure finance.
It is indeed my pleasure and honor to get HR Khan, the man whose report has really made the basis for getting this corporate bond market deepened. Thank you very much, Mr. Khan, for being with us. I must begin to ask you about the measures that have been announced. The RBI has fallen short of still accepting corporate bonds as collaterals, but are you happy with what has been accepted? I mean, large parts, partial credit enhancement and platform for repo corporate bonds, permitting brokers in corporate bonds, really making the market makers there, but a step short from accepting corporate bonds as collaterals, which will require changes in the RBI Act. Are you more or less satisfied with what the RBI has accepted of your report? Because that is really the basis of what we are seeing today.
No, I should say broadly I am satisfied, and this is a view which emerged out of a consensus of among government and regulators. It is not that all recommendations can be implemented in one go. So I am reasonably satisfied that some of the major recommendations, particularly corporates accessing market, has been accepted.
Actually, I do want to take this discussion forward, but I must throw a question.
Accepted, not accepted.
So what I know right now is that they have accepted the decision to aggregate limit of partial credit enhancement is now 50% from 20%, just for the benefit of our viewers and also for the benefit of Mr. Khan. So that is now 50%. They have permitted brokers in corporate bond repos. They have authorized the platform for repo and corporate bonds, and this will, of course, they believe, encourage credit supply for large borrowers through market mechanism. It has been decided to seek suitable legal amendments to enable the Reserve Bank of India to accept corporate bonds under the liquidity liquidity adjustment facility. There are many more things, and we will take it forward from there. But Mr. Khan, just for the benefit of our viewers, we really need to make it simple, and which is why we must ask you, why do you believe India needs a deepened corporate bond market right now? Is there over-reliance on banks for credits? And one of the reasons why this is being done is with that overarching thought that there is too much exposure that banks have to large corporates, and they perhaps need to borrow from market straight. Mr. Khan.
Yeah, you have given part of the answer you have given yourself. As you know, we are a bank-dominated financial system like many other countries. But beyond a point, if banks are overstretched, and we see the problems banks are facing, and the impact of over-leverage on the bank's balance sheet could have. So we need some source of diversification. We need a backstop. We need an alternative source of funding. That is why we need corporate bond market. And also, given the infrastructure need being so large and huge, we need to, because banks being in the short term deposits they accept, and they can't go up beyond a point to a long term funding. So this is something which bond market will provide the necessary resources for the infrastructure. So for diversification and for better price discovery also, maybe corporates will be able to get funds at much finer rate, and there will be much more transparency rather than relationship banking, which happens between a corporate and a bank in a lending system. So better transparency, more diversification, and more resources for infrastructure. So these are some of the factors which we need to keep for expanding the corporate debt market in India.
Fair point indeed, sir. I have many more questions coming your way, but I also have Anand Narayan who's joining us on ET Now. And Anand, I must ask you your quick take first on the measures that have been taken, the recommendations that have been accepted. And if I go by what has really been said, we are a step closer or a step away from RBI beginning to accept corporate bonds. It's perhaps just a formality now because there is an amendment of the RBI Act that's required that needs to be changed. But the fact that foreign portfolio investors will now be allowed to trade directly in corporate bonds and will be given direct access to the NDS OM to ease the process of investment, how significant a move is this really going to be to deepen our bond markets? Anand.
Good evening, and this does look like a very comprehensive slew of measures, and I must compliment Khan Saab, who's also there with you. I think he's clearly, his swan song has been fairly comprehensive as far as market development is concerned. I think the announcements which have come out today, and frankly I'm still reading them, and if it's just come out a few minutes back, are comprehensive across the dimensions that it's defined, you know, market development, participation enhancement, greater market liquidity, and communication. The few things I can pick up right away is on the first part of market development. Besides corporate bonds, by the way, they've also done a lot in terms of enhancing, hedging in foreign exchange, as well as opening the doors for better management in commodities, which is, I think, a very, very strong measure. You know, the reality is, while we have OTC derivatives for foreign exchange and fixed income, lots of Indian corporates and corporates have much larger exposures in commodities, which don't really have too many hedging instruments around, and they are limited in scope. So allowing and reviewing that, I think, is a big measure as well. Specifically on corporate bonds, though, allowing masala bonds to be issued by banks and financial institutions, partial credit enhancement, which again the industry has been asking for. I think that's very, very welcome. And as you mentioned, giving better access to FPIs, both on government debt as well as corporate bonds, that's pretty significant as well. The big prize, of course, will be if the RBI starts to accept corporate bonds under the LAF, the Liquidity Adjustment Facility. As Mr. Khan just mentioned, that clearly requires some enabling changes to the RBI Act itself. But it's good to see that the RBI states they've already started those the wheels in motion. So that's very, very positive. Allowing corporates to lend through repos without any restrictions of tenor or counterparties, that's again going to really enhance the participation of clients and of people in the market. All in all, it seems pretty comprehensive. I think, frankly, to discuss this properly, it requires more than 10 minutes to read the paper. But it does sound very exciting and, frankly, something that we can all look forward to.
So while I leave you with those 2 minutes to read the paper, I'm going to take it back to the author of this reform. And Mr. Khan, I will bring this back to you, and I want to break this down. The partial credit enhancement that has happened from 20% up to 50%, how much of a role is that going to play? Because I do want to get into specifics at this point in time. This was a long-standing demand to enhance that partial credit enhancement by banks. The demand also was that maybe at an individual bank level, it could have been done differently. But do you believe 20% to 50% is going to largely take care of the demand that was raised, Mr. Khan?
I think it should, and if I am not mistaken, the 50% is aggregate banking sector exposure by way of enhancement. Individual banks will probably still remain 20%. Let me come back to the point which you mentioned about LAF. I just had a quick reading of the press release. What he said that RBI will start working on amending the legal provisions so that it can be taken forward. So actually this is what we had broadly recommended. What we have said that once repo in corporate bond, market repo and tripartite repo get some traction and there is some liquidity, RBI will be much better position to do take corporate paper under LAF, and for that legal amendment will be necessary. And what we have suggested, pending that, whether you can examine whether pending that whether it can be done without amendment, but probably legal opinions can vary. So to better to have a clarity, RBI has thought that they will do the legal amendment, and as you know, government is also very serious on this. So I think this amendment should happen as early as possible. In fact, it was about to be passed during the last budget, but last minute probably something happened, it could not happen. But let me just take a quick thing on this LAF acceptability under LAF. You know, this is something which is a very major change, as Anand did mention. There are positives and negatives, but on overall basis, once RBI puts risk management systems in place in terms of tenure, maybe it will start with, it could be overnight, and in terms of haircut, in terms of rating, I think with those risk management tools in place, I think it will be a great thing for RBI to start once the amendments are in place, and it will have a lot of spillover positive impact both directly and indirectly in terms of banks and PDs holding, and there is a funding availability for this paper. So this is going to be a big game changer.
It is indeed going to be a game changer. Mr. Khan, just be with us for a moment. We've got Shilpa Kumar also joining in on ET now. And Shilpa, let's begin to talk to you about the specifics here. And let's go with question number one, the aggregate limit. And Mr. Khan is right in pointing out that it's the aggregate limit of partial credit enhancement that has happened from 20% to 50%. Your first view on that?
No, I think this is really very good because if you look at it, initially when 20% was allowed, it really did not translate into any improvement in yields, largely because 20% was never sufficient to get more than one credit rating upgrade, and really because that made it a structured paper. In effect, the advantage of the yield got taken away by the fact that it was a structured paper, and therefore in a sense market demands a higher interest rate anyway for structured paper. Now with 50% coming in, I think we shall see the true value of something like this, and essentially I think it's a really good move because a lot of corporates who can then in a sense increase their access to non-bank market through using this credit enhancement, a lot of these people will therefore be able to access markets much more efficiently.
Right. What do you make of the fact that FPIs can now access both government securities and corporate markets trade? Shilpa.
I think it's really a good development, and if I kind of look at the objectives of what this circular does, it really pushes a lot for efficiency and liquidity in financial markets, and allowing FPIs, who have now become a pretty integral part of Indian bond markets, allowing them access directly to NDS OM. I think it's indeed a very good development.
And what's your quick take on masala bonds that could be, the fact that FIIs can be issuing them and banks can be issuing them? This was a long-standing demand of the corporates. Finally, it finds favor with the RBI.
I think it's a great move. Essentially, last week itself, we were in fact talking to a group of FIIs outside the country, and the demand from their side was for masala bonds to take off. It's really important that names which are familiar to FIIs overseas, essentially being financial institutions and banks, they should be allowed to access this market, because the market will take off much faster. And I think it's really a great move for the Reserve Bank to allow this.
Shilpa Kumar, we appreciate you joining us on ET Now, and I will take the discussion back to both Mr. H.R. Khan, the architect and the author of this report in many ways, and Anant Narayan, and of course Maithili Busnurmat, who's here. Anant, the question that I asked Shilpa Kumar towards the end, which is about masala bonds, a long-standing demand of corporate India, do you see many more being raised now, given this is now, this has the blessings of the RBI, it was a long-standing demand of the foreign institutional investors?
Well, the first few issuances that we've seen in the masala bond have been pretty successful. Of course, the market is still very, very nascent, and both investors and issuers are kind of feeling the waters as we go along. But, you know, given the fact that the Indian financial system and banks requires an enormous amount of capital over the next few years, you know, every avenue that is available to raise these funds is very, very welcome. Clearly, masala bonds, the biggest advantage for us as issuers, for banks as issuers, is that it addresses a set of investors who otherwise cannot participate in the debt issuances locally or through ECBs, etc. So, to the extent it widens the investor base, I think it's very, very welcome. Hopefully, this will make its way into capital for banks as well as towards funding directly for infrastructure investments. You know, the other point you asked about partial credit enhancement. If you read that part along with the fact that FIIs have got a lot more of easy access into corporate bonds now, if you put the two together, ideally what will happen is, you know, we will see local banks providing, you know, capital credit enhancement to infrastructure projects, and being on the ground and knowing the risks associated with this a lot better than foreigners. That will then allow foreigners to participate in these bonds with the comfort that up to 50% of credit enhancement is being provided by banks who are going to put money where their mouth is. So I think it's a great way of ensuring that overseas money and investment flows directly into things like infrastructure investments. All in all, I think it's pretty comprehensive. Hopefully the execution and the last mile execution will go smoothly as well. And we can all then thank Mr. Khan for having done what he's done.
I'm thanking Mr. Khan more than anybody else right now on this channel for A, being with us, and B, being the author of this reform. But Mr. Khan, I have two questions. The release very categorically says that it permits brokers in corporate bond repos. So they're largely going to be market makers. My question is, could more categories not have been promoted and gotten as market makers? So that's question number one. And question number two really is coming in as far as credit rating agencies is concerned. I think one of your recommendations was that they should be given access to the data that the RBI has, although there was stiff resistance to that in certain other quarters. But I don't see a word on credit rating agencies, and every time they downgrade, it does leave an investor stranded. Should the RBI not have taken this into account? I'm sorry if I'm missing out on that point completely. Mr. Khan?
Yeah, Maithili, I'll just take, before I take you 2 points, very quickly on the point following of what Anand said about partial credit enhancement. This is very significant in the sense, you remember, RBI's position earlier has been that corporate bond market has to stand on its own, and the banks should not be supporting corporate bond because it becomes a banking bond rather than a corporate bond. But then the reality of Indian banks financial system being what it is, and we want that corporates to go to the market and to develop that market, I think we need support at least at the initial stage by the banks. So that is a major change, ideological change, quote unquote, I should say, from what you remember, what was our view when we frowned upon a particular bank when they gave a guarantee to the Tata Motors, and now to taking partial credit enhancement to 50%, basically to improve the market and provide liquidity so that corporates can move to the market, they find a market for floating their corporate bonds. On that repo by the brokers, you know, repo is a leveraged product, so one has to be very, very careful who are the fellows. But because we have exchanges where there are risk management practices are there are haircut, there are other risk management practices, that is why we felt emboldened that brokers who will be market makers, they can access repo on an electronic platform with all those safeguards. What was your second question? I just forgot that.
My second question was about the credit rating agencies, sir, because some people have gone out there and said that if they, whenever they downgrade, and that can be sometimes arbitrary, it does lead to a certain amount of panic and investors could be stranded. One of the suggestions that were made was that maybe these credit rating agencies should have access to data, but I don't think it's a part of this release at least.
The whole point is, at least, as I told you, one need not look for all the recommendations to be implemented and announced in one go. What in fact we are trying to say in the report is that there are best practices and our rating agencies are being regulated in terms of best IOSCO principles, but in terms of compliance, there are market fill, there are gaps, and we have seen some examples where credits have sharply fallen, but the information has not flowed in. So and their credit rating agencies are eligible users of credit bureaus. So they should increasingly use that, and what we have said, banks are also encouraged to give weekly basis information about the corporate, because if it is 6 monthly basis information comes and between 2-6 months, between 2-6 month major significant thing happens, then credit rating agencies are handicapped also, and that's why we are telling information flow should be near real time, and they should also publish information as more greater intervals as much as possible, so that the information flow to the market is faster.
I'm going to take this to Maithili, and Maithili, I know I came to you for opening comments there before everybody else joined in, but do you believe all the measures that we've discussed so far and all the schemes that have been announced, of course credit rating agencies notwithstanding, is this going to reduce the reliance on banks as a source of credit, at least for the big corporates? Market mechanism and market borrowing is what the RBI wants them to do, and perhaps restrict bank lending to the smaller corporates, to the smaller companies. Do you believe that objective is going to be attained with something that we are seeing today? Maithili.
Well, not immediately, Supriya, but that is a medium to long-term hope, because the larger corporates can access the market directly, and sometimes they may be able to get even a finer pricing than they get with the banks. So the hope is that the larger corporates who can stand on their own and access the market on their own, they should go to the market. That will also enable better transmission of the RBI's monetary signals, and the smaller corporates who perhaps cannot access the market so easily, either it's because it's so expensive or because they are not very well-known names, so they have to pay a much higher price. So they can come to the banking system. So if the dependence of the larger corporates particularly on the banking system will come down, and the banks will be able to serve the underserved at the moment, especially the SMEs, because there is a great deal of focus, particularly with the present government, to increase market bank access, credit access to the MSMEs. So that perhaps will happen, but none of this is going to happen immediately. It is a long haul, but the RBI has made a beginning. In fact, they have been working, Mr. Khan, in fact, perhaps could be called the father of the corporate bond market in India, because he's really been very actively involved with promoting the corporate bond market in India. But these are all relatively fairly medium to long-term measures. So even though it will not happen overnight, it is a welcome first step. But Mr. Khan, if I could ask you, even though, as I said, you've really done a lot of work trying to promote the corporate bond market in India, the fact is that the market still remains largely confined to institutions, is largely dependent on private placements. So when do you see this change, either in terms of issuers or in terms of investors?
No, as you have seen our report, possibly it has come out on the website, we are focused on all the 7 dimensions of it, knowing fully well that there are limitations and corporate bond can go up to a point. Beyond that, it still remains a bank dominated system. So what we are trying to do is, over a medium to long term, that a large chunk of corporate borrowing should go to the corporate bond market. So that's why the whole host of recommendations, as Shilpa said, that things will happen over medium term. They can't happen overnight. But in the directionally, we are moving, taking care all the dimensions, whether it is issuer, whether it is investor, whether it is instrument, whether it is infrastructure, whether it is incentives, or whether in terms of innovations. So the all aspects have to be done. And the major thing which has happened in the last budget, we had also mentioned in our report, is this bankruptcy code, which was a major thing which was pending for a long time. Now the challenge is in terms of setting up those codes, having the IT infrastructure, having the insolvency professionals. So these implementation issues, have they taken care? I think that's a major change in terms of bankruptcy code, and which is a major demand, particularly from the foreign investor, that we don't have a very well laid out bankruptcy framework. So that is another big game changer which is going to take place.
Absolutely, Mr. Khan. But Anant, if I can turn to you, though the RBI's latest circular does try to incentivize foreign portfolio investors to enter the corporate bond market, the fact remains that unlike the GSEC market, which the FPIs have happily lapped up, only about 65% of the limit that has been allowed to FPIs has been taken to date. Because understandably, FPIs are very wary of getting into the corporate bond market precisely for the reasons that Mr. Khan talked about, the fact that we don't have a very good resolution mechanism in place. It's very difficult if the bonds are not honored. So do you think this kind of incentivizing them in terms of hedging, in terms of allowing them to access the NDS, OM market, etc., will make a difference? Will they bite more readily? Anand?
I think it will, Maithili. Look, as you said and as Mr. Khan said, this is a journey which will go over time. As we improve the liquidity of the underlying bond market, the corporate bond market, clearly the comfort that overseas investors have in investing into that market will increase. Now, a lot of steps have been taken here, including, allowing for credit enhancement, including allowing for repos by brokers, allowing better participation by corporates. All of this will go a long way in improving liquidity. Now, if the other recommendations of the Khan Committee are also kind of addressed by the other stakeholders, including SEBI, including PFRD, etc., we will see liquidity improve even further. Once that happens, clearly the comfort for the FPIs to come in will come in. Look, there's no magic wand which one day we can wave and then corporate bonds will become active from tomorrow. Even after all this, there are things that we need to do, including the fact that we have to look for one benchmark rate which will apply to the financial institutions and to the user community. We'll require the term money market to develop. So a whole host of things have to happen. But clearly the announcements which have come out today, I think personally, is a watershed in that journey towards getting that liquidity and therefore greater participation.
Right. Anand, hold your thoughts there, because I do want to bring this back to Mr. H.R. Khan. And Mr. Khan, one of the recommendations that the working group had made were related to the tax concerns that were raised. And it was very categorically said that the stamp duty on debentures should be made uniform across states and be linked to the tenor of securities within an overall cap. I think the release doesn't talk about this, and that could have perhaps brought in a lot of comfort, a lot of confidence with that tax issue being taken care of. Is this work in progress according to you, or do you believe this isn't such a crucial issue at all? Mr. Khan?
No, Maithili, just as Anant was telling, this is an announcement pertaining to the areas of Reserve Bank of India. And as I told you, government and FSDC, finance minister, everybody is all the regulators are concerned about it. And in fact, in our report we have mentioned Governor Rajan and Chairman SEBI, Mr. UK Sinha. We had a discussion before this report came. So all of us are committed to implement. And the stamp duty part also, government is quite seized up that matter. And I think they are working on that direction because it is in the domain of government. The other thing which we have recommended, which possibly can also be done very easily, is that reissuances should not be treated as a fresh issue and no fresh stamp duty should be levied. I think all these issues relating to stamp duty, I think government is serious to implement.
Mr. Rajesh Mukasey, we also have Mr. Rajesh Mukasey, MD and CEO of CARE Ratings. Mr. Mukasey, how important a role do rating agencies really play in the entire corporate bond market? Because post the financial crisis and what we've seen, particularly with the downgrading of Amtech Auto, rating agencies did not really cover themselves in glory. So is this a chance for them to redeem themselves, Mr. Mukasey?
Yeah, I think rating agencies play a very important role in the corporate bond market because investors who need to invest in the corporate bond market cannot have a quick and ready information on the credit quality of the bonds from any other source on an ongoing, real-time basis in a practical way. And the rating agencies all over the world serve this piece of information. And in fact, that is an essential ingredient for the corporate bond market to exist. And without this piece of information, the corporate bond market may not exist. So it's a very, very root and essential part of the corporate bond market. Yes, I think I would say that on an overall basis, if you see the performance of the rating industry in India, I think they've done a fairly good job. Obviously, there are going to be outlier elements which are always going to be part of any bond market, and one cannot just wish away that aspects, because today the way the risk and volatility happens in the markets, things are somewhat difficult to visualize, and there is much more volatility in the coming in as a result of the underlying fundamentals. But yes, the rating agencies world over continue to play a very crucial role, and the Indian rating agencies have also done a commendable work over the last several years.
Mr. Mukashi, though, a very quick question is that what sort of access do you need and what sort of a database do you need and access to as a rating agency? Because it is your word and it is your rating that really leaves either investors confident or stranded. And which is why a very logical question to ask is that, do you need more access to databases? One of the recommendations that were made by the working group is that maybe you could have been given access to the central repository of information on large credits. I don't think that's found a favor here, but is there more access you need to RBI database or government database?
I think this aspect has been touched upon by the Khan panel recommendations, which were issued earlier by RBI. And if you really see the problem about the information flows is that on a bond market default, only a trustee lets us know on that day that there is a default. It's very difficult to verify. A company may not or may not be always be factually right on certain things in a timely basis. So the trustees often are very, very important in terms of letting us know that there is a default on a particular bond issue. Now, coming to the loan markets as such, it is extremely difficult to figure out when there is a default or a missed payment as such. And to that extent, I think the concern has been how quickly do we respond to such pieces of information and let the market know about the default. And to that extent, I think access to credit information companies or special databases from Reserve Bank of India, which are used for getting data from the various banks, that access is very crucial to the rating industry as such. And I think we have already, most of the rating agencies are in touch with the regulators on this particular aspect. And I am sure at some point of time that a piece of information or access to information will be given to the rating agencies. This will help us respond quickly on any developments in the bond market or the loan market as such.
All right, just hold your thoughts there, because Maithili, I do want to broad base this discussion a little and talk about cost of lending and cost of borrowing here. We were having this chat earlier and you said monetary transmission is going to be a lot easier in the bond market than it is perhaps in the banking system, a lot quicker as well. You hold on to that view, Maithili?
Yeah, absolutely, because in the case of banks, the problem is that since loans are on a floating rate and the deposits are a contracted fixed rate of interest, it becomes very difficult for banks to really transmit that signal from the Reserve Bank either up or down, because their cost of funds is largely based on the cost of deposits, over which they have very little control, because as I said, these are fixed term interest rates. So given that when corporates go directly to the bond market, this kind of handicap is not there. So they will be able to get a better pricing and the signals will be transmitted much more smoothly than they do in the case of the bank. So to that extent, it will certainly be better. Monetary transmission will be better to the extent that dependence on the banking system comes down, particularly in the case of large corporates. But Anand, if I can turn to you, I know you were a very keen votary that RBI should allow netting of OTC derivatives. Now, is this possible? I don't see anything in the circular. I haven't had access to the circular complete details, but have you been able to read it, I think? Have you seen anything about netting of derivatives?
Maithili, it seems to be conspicuous by its absence, and you're right, it's one of the issues which were flagged off by the Khan committee as something which the RBI could perhaps preempt by way of a notification. But it looks like RBI has decided not to proceed along those lines. So perhaps they're waiting for the actual legal clarity to come through via a change to the RBI Act itself. It has ramifications beyond what the Khan committee mentioned. The Khan committee mentioned about the CDS market not taking off because of netting. But it's not just the CDS market, it's the whole plethora of OTC markets across foreign exchange, fixed income and options and so on and so forth, which is impacted. I guess we'll have to watch the space and hope that the notification comes sooner rather than later. But yes, I don't see any clarity on the netting aspect. And that's probably one aspect which was a deliverable of the RBI, which the today's announcement doesn't address.
Okay.
Maithili, you have a question there?
3 more recommendations of your committee report which you would like to see in action. Which would those 3 be? Apart, of course, from the use of the LAF repo being accepted, in corporate bonds being accepted under LAF, which I think is one of your main demands. Which are the other two demands that you would like to list as the three most important things that you would like to see happen to get the corporate bond market in motion? Mr. Khan?
Whom are you asking this question? Oh, to me? Okay.
No,
as one is, as Anand mentioned, the CDS and netting part has to be, I think we need to work on that. Pending legal amendment to the RBI Act, whether based on some legal opinion, whether it can be, that needs to be examined. And the point you mentioned about stamp duty is something. And of course, there is there are few areas where SEBI has to take steps in terms of integrated trade repository. And finally, as I mentioned, the implementation, the transitional issues following the bankruptcy code, I think on that also we need to get going. So these are some of the areas we need to work further.
Mr. Khan, while we are wrapping this up, we will take a quick last round of questions with all of you. And if I may begin with you, it does require, and work is in motion, because it very clearly says that work has begun on amendment of the RBI Act. It has commenced as far as accepting bonds under the liquidity adjustment facility is concerned. How soon do you expect this to be really taken up? How soon do you expect this to be a reality? Because I'm presuming amendment of the Act will involve legislative action.
As you know, I am no longer within the part of the RBI's establishment. So I will not be able to venture at what time frame they have fixed. But I am sure, given the importance being attached by all the stakeholders, government, RBI and other regulators, things will move faster than what you probably think.
Anant, thank you very much for patiently standing by, and we've been pushing our time limit with you, but that 23% share, all right, I think we've lost our connection with Anand, but Maithili, we've been speaking about how the market share of non-banking borrowing and direct market mechanism has to really go up. When do you see that happen? What is the time frame we are looking at? I know it's not going to happen overnight. This is a good attempt at deepening the corporate bond market, but perhaps something that's not going to kickstart right away. When do you see that fine balance between bank lending, perhaps for the smaller corporates, and the large corporates having exposure to market mechanisms?
I think one big stumbling block, Supriya, will frankly be in actionalizing the bankruptcy code, because there's a whole plethora of the ecosystem which has to be set up. You need to have insolvency professionals in place, you need to have various kind of other bodies, professionals in place to do the entire process of liquidation, etc. And you also need to get the costs out of the way, because the problem is that in India, even though we've set up specialized tribunals in various areas, whether it is in tax, whether it is in DRT, the fact remains, company law tribunal, the fact remains that ultimately the recourse to the High Court and the Supreme Court remains. And as long as that access to civil courts remains, I think the bankruptcy code will remain largely on paper. And that is the reason why, unless you want to have quick action, if you want to have a time frame, it should be possible for you to say that the tribunal's verdict is the final say, and only in very, very limited cases should you be able to go approach, and that too only to the Supreme Court. So I think that's going to be the biggest stumbling block. If we're able to overcome that and ensure that the insolvency code, the bankruptcy code is really actionalized and the entire paraphernalia that we need is in place, I think a time frame of maybe 5 to 10 years should see this completely in place. Otherwise, at the moment, it is a work in progress. It's a very good beginning, but it's a long haul. But any kind of institutional change does take time. So I think it's naive to expect it to be a magic wand. It will not be, but it's a very welcome change.
Fair point, India. And Mr. Mukashi, a last question to you then. How much of your life gets changed, and what sort of a pressure our credit agency is going to be under? It's one thing to, rate bonds, and it's quite another that investors begin to make bets on the basis of your ratings. Will ratings perhaps be a lot more cautious than they have been in the past?
No, I don't think so. I don't think so. Ratings have always got to be... Hello?
Carry on, sir. We can hear you.
I think ratings have always got to be on the fundamentals and the whole examination, the outlook for the particular underlying obligor as such. And the whole issue, the whole developments out here only encourage the development of the bond market, more liquidity, more credit. The credit enhanced bonds coming into the market. All these are related to the development of the bond market, and that means probably more action for the rating agencies as such in terms of rating many more entities and all such developments. But the fundamental analysis standards don't change because of these regulations as such. Only more information access and things like that were also there part of the regulation. Things will move much faster than what the impediments which the rating agencies face today.
All right, on that note, we really thank each one of you for joining us. Anant Narayan, Mr. Rajesh Mokashi, Maithili Basturmat, and of course, above all, Mr. H.R. Khan, the author of, and like Maithili said, someone who's perhaps going to be called the father of Indian bond markets. Thank you very much for being with us right here on ET Now as we discuss and debate a big reform and perhaps Raghuram Rajan's last hurrah from the RBI. Thanks, viewers, for tuning in.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.